Stocks look like they are set for a rebound after seeing some positive data earlier this morning. Joining me today to talk about this is Keith Bliss from Catone & Company. Keith, thank you again for joining me. So it seems as though the market is trying to rebound after seeing some of this positive data. So I'll start with the durable goods orders, which we had talked about in a previous interview. And you said that when you do exclude aircraft, looking at year-over-year growth since the financial crisis, we haven't exactly seen that. So even though it was positive today, do we still need to be concerned about the future?
Always. Manufacturing has been the renaissance that really hasn't materialized the way we need to see it. And I think part of that has to do with the way the U.S. economy has shifted from one of an industrial manufacturing base to more of a service-oriented economy. That has something to do with it. But also, listen, global demand is still fairly weak. We manufacture not trinkets and other types of gadgets here in the United States, but we manufacture big-ticket durable goods orders. So we need to see that pick up more, but listen, these are positive signs. We'll take a month of positive growth anytime. Now we need to see that trend sustained to really feel good about that the economy is getting to that escape velocity, which is what the Fed needs to see.
Now, as the Fed, there's a lot of speculation about them possibly pulling back on their QE program, maybe even in September. But when we do look at durable goods and manufacturing, is that where we really need to see the key point there if the economy can't sustain without that stimulus being pumped into the markets?
There are several metrics that we need to look at. We need to see growth, sustainable growth in a lot of those metrics. We need to see sustainable growth in real wages and incomes. We need to see sustainable growth in getting the unemployment rate down. We have our final reading on first quarter GDP tomorrow, so that's going to be a very important metric that we're going to look at. But one thing's for sure is that nobody should have been surprised that the Fed at some point has to pull out of this bond buying program. They've been in it now for, it'll be going on 5 years soon. It's the speed with which they do it, it's the level with which they do it that has got people spooked. I think a lot of people parsed apart Chairman Bernanke's words last week, and all they heard was that they were going to be out of the bond buying program. That's not it at all. And you've seen various Fed presidents come out in the last couple of days trying to calm the markets and soothe the markets a little bit. And in fact, starting tomorrow, we have 9 Fed officials that will be giving speeches of varying degrees for the remainder of the week. It's on different subjects, but I'm sure they'll take the opportunity to say, listen, don't fight us on this. We do not want long-term rates to rise. We're not out of the woods yet with the economy. We see it on the horizon, but we're still not there yet. So, yeah, that spooked the markets. The markets got vastly, vastly oversold. I mean, it's an incredible buying opportunity, in our opinion. You see these very rarely in your career, and I think we got one of those. Yesterday. So I expect the markets to lift from this point forward in the next few sessions.
Now, you did just bring up that we do need to see wage growth accelerate. Now, we do see personal income come out on Thursday, and today when we do see new home sales and housing prices rise, that comes with that sort of wealth effect. And how long can that last if incomes do just remain at those same levels?
It's the key point. When it comes to an economy where you have 70% consumerism, and we're an economy that is built on debt and consumption. I mean, you just can't escape that fact right now. So you're right, the wealth effect has been masterfully orchestrated by the Fed. Home prices have gone up, equity prices have gone up, the home market is on fire right now, new home sales, existing home sales. There's just, it's really going quite well right now. But that won't last long unless we get real wage growth in this country. And that's been stagnant for the last 2 years. A lot of people forget about it. We feel better because we turn on the TV every night and we see the S&P hitting a new record and the Dow hitting a new record every day, and we see home prices accelerating. But at some point, consumers will max out what they have in their pocket because they don't have real wage income growth, and they'll max out their savings accounts, and they'll also max out their debt limits on their own credit cards, and then the economy really starts to seize at that point. So we need job growth, we need real wage growth, and that will keep the economy accelerating forward to those types of growth rates that we've come to expect when we come into a recovery.
And finally, tomorrow, we will see first quarter GDP revised again. It did fall slightly from the 2.5% to 2.4% the last time. Do you expect to see any changes based on some of the data we have seen recently?
I think the data that we've gotten from the advanced look that we have is pointing to a pretty good number around 2.4, 2.5. Pretty good from the standpoint of that's what's expected. We need to see GDP up above that 3% level to really sustain what's going on, and to have, I think this is a key data point that the Fed doesn't talk about all that much. They always talk about wage growth and they talk about unemployment. But real GDP at 3% will then make them start to pull back on their bond buying program. And everybody needs to remember what the Fed is saying is the bond buying program is really to keep long-term rates lower. They're going to keep short-term rates well into the future. They've not even given an end date for that. But anyway, pull back on the bond buying program because of this economic data points. I think if the GDP comes in at 2.4, 2.5, it'll give the markets confidence that the economy is moving in the right direction, and even if the Fed does pull out on some of those long-term bond buying programs, the market and the economy can sustain itself.